Hi everybody, and welcome back to video number 9 in chapter 18. And when we left off, we were looking at balance sheet presentation of deferred taxes for 2024. And here we have our current liabilities, income taxes payable, 30,000, and long-term liabilities, deferred tax liability, the $93,200 minus the $31,200, or $62,000. Okay, and then the income statement presentation of income tax expense for 2024. We're going to have income before income taxes of $412,000, and then our income tax expense will be comprised of current $30,000, deferred $62,000, total $92,000, for a net income of $320,000. Okay, in the second year, during 2025, Allman collected $112,000 from customers for receivables arising from contracts completed in 2024. The company expects recovery of the remaining receivables to result in taxable amounts of $112,000 in each of the following 3 years. Number 2, in 2025, the company collected 4 new contracts that allowed for the customer to pay on an installment basis. These installment sales created new installment receivables. Future collections of these receivables will result in reporting gross profit of $64,000 for tax purposes in each of the next 4 years. Number 3 here, during 2025, Allman continued to depreciate the assets acquired in 2024 according to the depreciation schedule we presented earlier. Therefore, depreciation amounted to $90,000 for financial reporting purposes and $172,800 for tax purposes. And then lastly, number 4, an analysis of the end of 2025 of the product warranty liability account. It showed the details. And here was our beginning liability, our expenses for income tax, for income statement purposes, the amount paid for contracts completed in 2024, and the amount paid for contracts completed in 2025. And finally, our balance of liability at the end of 2025 of $230,000. Okay, and then the balance of the liability expected to require expenditures in the future follow. And here we have $100,000 in 2026 due to the 2024 contracts, $50,000 in 2026 due to the 2025 contracts, and finally $80,000 in 2027 due to the 2025 contracts. And here's that $230,000. Number 5, during 2025, non-taxable municipal bond interest revenue was $24,000. Number 6, Allman accrued a loss of $172,000 for financial reporting purposes because of pending litigation. This amount is not taxable until the period the loss is realized, which the company estimates to be 2033. And then finally, pre-tax financial income of 2025 amounts to $504,800, and the enacted tax rates still in effect are 30% for 2024 and 20% thereafter. Okay, so the computation for taxable income in 2025 We'll start with pre-tax financial information. Here's our permanent differences, $24,000. Reversing temporary differences, here and here. Originating temporary differences of $256,000 negative for the 2025 contracts. Excess depreciation per tax of $82,800. Excess warranty expense per the books for 2025 contracts, $130,000, and a loss accrual per the books of $172,000. So after all of that, our taxable income is going to be $500,000 for 2025. Okay, so here, if our taxable income is $500,000, we'll take 20% of that, and that will be our income taxes payable, current tax expense, for 2025. And here's a schedule of future taxable and deductible amounts. I'll let you read these on your own, but here's our breakdown of all of those future taxable deductible amounts for 2026, 27, 28, 29, and finally 2033 when we take a loss on that litigation, and our sums. Okay, so here we have the computation of deferred income taxes at the end of 2025, and Allman computes the amount of deferred income taxes to be reported at the end of 2025. So they take these temporary differences here, totaling $290,800, and it's probably worth mentioning that this $592,000 of installment sales are the cumulative temporary differences here of $336,000 and $256,000. And we multiply those through times the 20% tax rate, and that gives rise to a deferred tax asset here of $46,000 and $34,400 for a total of $80,400, and deferred tax liability of $138,560. So we can compute that $290,800 times 20% is going to be equal to the $138,560 minus the $80,400. Fairly complex there, but I think you understand it. Okay, to determine the deferred tax expense benefit, Allman must compare the beginning and ending balances of deferred income tax amount counts. So you'll remember the $80,400, that's the deferred tax asset at the end of 2025. The deferred tax asset at the beginning of 2025, that means we have a deferred tax expense bracket benefit of negative $49,200. And then we have our deferred tax liability at the end of 2025 and the deferred tax liability at the beginning of 2025, resulting in our deferred tax expense bracket benefit of $45,360. So if we put that all together, I have a deferred tax expense benefit of negative $49,200, a positive $45,360. So the net of that is a negative $3,840, and our current tax expense is $100,000. Therefore, our income tax expense total for 2025 is $96,160. Okay, Now, our income tax journal entry for 2025. The deferred tax expense of $45,360 and the deferred tax benefit of $49,200 net to a deferred tax benefit of $3,840 for 2025. Therefore, we're going to record the following journal entry. We'll have income tax expense of $96,160 debit, and we'll also debit the deferred tax asset of $49,200. We will credit income taxes payable for $100,000, and finally credit deferred tax liability of $45,360. Pretty straightforward there, I think. Okay, so now in computing the total income tax expense for 2025, here we've classified the deferred tax accounts at the end of 2025. Here's all our temporary differences here and the resulting deferred tax asset and deferred tax liabilities that we've calculated previously. Now, the balance sheet presentation then of deferred taxes at the end of 2025. Here we have current liabilities. We're going to have income taxes payable of $100,000. And our non-current liabilities, here we'll have our deferred tax liabilities representing the $138,560 here minus the $80,400 for a net of $58,160 in non-current liabilities. Okay, then for the income statement presentation of income tax expense, here our income before income taxes was $504,800. Our income tax expense, current $100,000, deferred $3,840 for a net of $96,160. Therefore, our net income is going to be $408,640. Now we'll take a look at explaining the accounting for loss carrybacks. Loss carrybacks, we have Tax Cuts and Jobs Acts of 2017. TCJA permits the carry forward of current net operating losses to offset future taxable income. The TCJA eliminated carryback provisions for NOLs. So the loss carryback, through the use of a loss carryback, a company may carry the net operating loss back 2 years and receive refunds for income taxes in those years. The company must apply the loss to the earlier year first and then to the second year. It may carry forward any loss remaining after the 2-year carryback to offset future taxable income. Important slide there. Okay, so the loss carryback procedure then, here we can go back 2 years, our 2025 loss, and then we can carry forward any additional. That looks like a good place to stop this video, and when we return, we'll take a look at a loss carryback example. Until that time, bye for now.